Are you a business owner and unsure of the financial statements of your company and what they mean and how you should analyze them? Well, if so, great, this video is for you. Hi, my name is Chris Passmore and I'm your social media CPA. So in my last video about accounting, I talked about the 4 foundational terms in accounting: general ledger, trial balance, debits and credits, adjusting journal entry. We're now going to build on that and talk about the 4 most common financial statements that you will see as a business owner. So let's start this off. The first financial statement I want to talk to you today about is the balance sheet. The balance sheet is a financial statement which is intended to portray the position of the company at a point in time. And this is important, and I emphasize point in time. The rest of the financial statements we're going to talk about today will be over a period of time, a year, 6 months. But a balance sheet is as of a day. For example, December 31st. So it's a snapshot. And the balance sheet will present the assets of the company, such as your cash, your accounts receivable, your inventory, your fixed assets, followed by the liabilities, which would include accounts payable, accrued expenses, trade payables, any debt or loans, and your equity. And the reason why it's called a balance sheet is because the total of your assets should equal the total of your liabilities and stockholders' equity. That's how this is built. They're meant to offset each other. So that balance sheet tells the story of your assets and liabilities at a point in time, and also assesses the liquidity of the company, how much cash you have and how you can maintain operations in the future. So now let's talk about the income statement or the profit and loss statement. And again, this is now talking about a period of time. The income statement typically is for a year, and oftentimes it's for the year ended December 31st. And again, to contrast that, the balance sheet is as of December 31st. So your income statement will summarize the revenues and expenses of your company. The revenues would be your product sales or your services that you've provided. It will then list the cost of those services or the cost of goods sold. If you are a manufacturer, that would be the cost that you had into the product that you sold, followed by gross profit. This is how much profit you make on those core products. After sales and cost of sales, you would list operating expenses. These would be things like rent. And then ultimately down to the net income of your company. The net income is supposed to represent your accrual-based or your cash-based profit, how much money you had at the end of the year from your core activities. I would say that the income statement is one of the most widely looked at financial statements of all of them. Whether you are applying for a bank loan or looking to raise capital or to attract new investors, they often look at the income statement because it tells, first of all, are you making money or are you losing money, which is important. But it also tells how healthy the company is, if you're making a strong gross margin. And they often look at other terms like EBITDA, which we'll talk about in additional courses down the road. But again, the income statement is one of the most popular financial statements that will be looked at when you're sharing this with vested parties, bankers, stockholders, and other people. So the third statement I want to talk to you about today is the statement of stockholders' equity. Also over a period of time, commonly for the year ended December 31st. So the statement of stockholders' equity only rolls forward the activity of the company related to equity. So what's equity? There are a number of different forms of equity, but the most common things you'll see in equity are 3 things. It's your common stock, how many shares you've issued. It is your additional paid-in capital and your retained earnings. There are other forms of equity that are complex, but generally those are the 3 that you're going to see on most of your company financial statements. So the statement of stockholders' equity just takes the activity as of the last period, if we're talking about a calendar year, from December 31st of the prior year to this year. And If it's a normal year, you have a company that's been formed and been in operations, more often than not, the only activity from year over to year is just your net income or your net loss. That will be your change in your retained earnings. So even though it may sound overwhelming, your statement of stockholders' equity, it's actually very simple, because more often than not, the activity is limited to one or two things like your profits. The last statement I want to talk to you about today is your statement of cash flows. This is a statement that measures your incoming money from sales, or maybe you took a loan from a bank, and your outflow of money. This is the payment of your bills, purchases of property and equipment, repayments of loans, and things of that nature. So the statement of cash flows is meant to summarize your incoming and your outgoing funds. There are two general types of cash flow statements, and you might read about them in a textbook. And the reason why I say that is it's in a textbook because everybody in practicality only uses one. So you have your direct cash flow statement and your indirect cash flow statement. We'll get into more detail about those in a video down the road specifically for cash flows. But I can tell you, I've been practicing for 20 years, and I have never seen a single company, a controller, or a CPA use a direct cash flow statement. 9 out of 10 companies use the indirect cash flow statement, and that is the most widely accepted form of cash flow statement. And again, this summarizes your collections of money, your incoming money, your sales, your revenue, and then your outgo of money. Imagine if you bought a piece of equipment for your business, that would be an outflow of money, so that would be shown as a negative amount on your cash flow statement, and that would be for a period of time. So those are the 4 most common financial statements that you will need to run your business, or that your controller or bookkeeper will prepare for you. Several of these financial statements are automatically built into various general ledger programs like QuickBooks. If you go into the reports module, it'll often have profit and loss or an income statement and a balance sheet. But this is the most commonly used ones that you need to know about, that you need to understand to effectively run your business. So we're going to keep building on this series, and in the next video we'll talk about specifics of the balance sheet, the individual items that go into the balance sheet, like your accounts receivable and inventory. So I hope to talk to you again, and I hope you found this useful, and have a good day.